Today's an important Mastermind Monday because, as realtors, one of the most important things that we can do for our real estate career is to stay up on the market. What is happening? And, realtors are always late to the party, but this is why we do these on Monday so that you're not late to the party. And today you might have seen him speak to us before, but we're going to have John Tavarez with Carrington Holdings that is going to speak to us about what's going on in the market. John is actually, you're at the Mortgage Bankers Association convention as we speak. So, can you all meet him? There we go. Sorry about that, John. But anyway, John, you know how realtors are. They're going to flow in here as we get going. But John, thank you for coming back. Welcome. Thanks for, taking your time to spend with us today, because I want to understand what is going on in the market as it relates to mortgages.
Perfect. Yeah. Thanks, everybody. Yeah, really well timing for the call out here in New York at the MBA secondary conference. So pretty much every large servicer and lenders capital markets team is out here. This is more of the side of the residential market where you're buying and selling whole loans and doing kind of deals like that versus the kind of one-off transaction. So I've had a lot of really good conversations and kind of insight on the market and where people think the market's going to go. And actually was fortunate enough to have dinner with the president of the MBA, Bob Berksmith, last night. There was just about 6 of us at dinner, and all was incredible to kind of pick his brain and, obviously the conversations that he's having, being in, doing lobbying work up in Washington, D.C., and just those meetings he's sitting with. He's flying tomorrow to meet with, internal revenue, the Secretary of State, et cetera. So a lot of big meetings there. So just incredible kind of insight whenever I leave this conference. And, the biggest thing that we were talking about last night, and, just it's really been the theme over this last year, is it's really the first time in the mortgage industry that you have people who are not necessarily paying their mortgage because they might have lost their job or something might have happened to them, but they still have equity in their home, right? Their home is appreciated since they got that mortgage, but they're really scared or uneducated and don't, know what to do, for example. And the other interesting part is the government right now, because it's the first time really in the history of the mortgage market as well, the government has backed 93% of all residential mortgages out there in existence today, which is $12.8 trillion worth of mortgages. Wow. So just to kind of put that in perspective, the last time we had a big financial crisis was obviously the 08 to 010 timeline, and the government backed, I think it's 32% of mortgages that time. And so what I mean by that is an FHA, VA, USDA, Ginnie Mae mortgage, where it's originated by, let's say, Carrington or Loan Depot or Quicken Loans, but then the government essentially sells that mortgage to, in a bond, to the government of Japan, the government of Argentina, and they're saying that if someone buys this debt, right, that the U.S. government guarantees you're going to be paid that every single month, et cetera. And so in 2008-9, like I said, that number was around 33% of every mortgage out there. Today, it's 93%, right? So the government has a huge interest and of what's happening in the mortgage market, more than they ever have before. And it's the first time in the history that, like I said, almost 80% of all mortgages were originated between 2020 and 2022. So all fresh, new mortgages. We kind of obviously had this crazy pandemic that had a lot of, I'll call, unnatural things happen to the economy with stimulus and money and rates being an all-time low. And now you've started to have that correction. So we're in a unique environment where a lot of these homes and homeowners still have equity in their house because it's appreciated so much, but they maybe have lost their job and they aren't paying their mortgage. So generally what happens in that process, obviously, is a company like Carrington or one of these large servicers or JP Morgan Chase or Wells Fargo, if you don't pay your mortgage after 90 days, they start the foreclosure process and come in and essentially evict you out of your home. And then they sell it to recoup their debt or their investment on that property. After talking with the MBA and being here this weekend, it's again, a kind of another first where the government is really putting pressure or advising to not go through the foreclosure process, right? To work with that borrower to either modify that current mortgage, which means, let's say I got a mortgage in 2021 for easy math, $100,000. I paid, 10% of it up front. So I've got a $90,000 mortgage that's structured over 30 years at 4%. Well, I lost my job, so I stopped paying my mortgage. My house is appreciated to, let's say, $120,000. And what they're advising is that even though we would normally come in and foreclose, is reach out to that borrower, say, hey, we know you're not, your mortgage is not performing, you're not paying. Let's redo it, essentially. We're going to, now that you have, your home value has increased, you're still at, let's call it $88,000 on the debt. So that margin has increased. We can essentially rewrite this mortgage as a new 30-year mortgage or a 15-year mortgage. Yes, at a higher interest rate, but it's now at a different payment for you. And maybe they introduced the 40-year mortgage. So there's a lot of different tools that the government is giving us servicers and lenders to be able to keep people in their homes. Right. So that is definitely a unique time. And I promise I'm getting somewhere here by the end of this.
Yes, we are. We are. Well,
Uh,
John, I want to stop you real quick
yeah.
because, as we talked about, everybody's popping onto this call. And I want to go back through a couple of things for those that jumped on a little bit after we started. But one, there is $12.8 trillion worth of mortgages that are out in the United States, $12.8 trillion worth of mortgages. 93% of them are insured by the United States government. That is a lot. And so what John was saying is back in 2008, 2009, 2010, 2011, if there were people falling on hard times and couldn't pay their mortgage, back then there was only 35% of those loans insured by the US government. So that's drastic. I mean, that is extremely drastic as far as where this puts us as a government, even. Because what happens, I mean, again, it's different times because a lot of these people have equity in their homes. But in the event that some of these go, upside down as far as them being able to pay their mortgages back, what does that do to the United States government? That's scary, John.
Yep, no, exactly. And so there's a lot of conversations happening here at this conference with all the heads of those different groups, FHA, Ginnie Mae, the VA, USDA, et cetera, to understand and talk with these servicers to understand what are their foreclosure amounts looking like. Is there a way to kind of, essentially kick the can down the road of, hey, can we get this person into a new performing mortgage? That's why they rolled out the 40-year mortgage, right? Because it allows them to keep at least something coming in the door to pay those debts back. And, it's just, you can think of the US government and the housing market as, just like a mortgage, right? They have 93% of that debt is covered by the US government. That's a huge number that needs to be paid every month to these other bondholders who are generally other countries. And so they're extremely, levered, if you will, that they need the housing market to continue to perform and to continue to stay on track to allow us to continue to operate in the manner we do. And if there was to be some huge fallout, there would be serious issues, right? There would need to be some stimulus package or something to essentially bail out. So that's the interesting part is they always say, oh, bail out the, mortgage servicers or bail out, the lending institutions or the banks or whatever. But it's really to bail out the US government, right? Yes, they are taking the money and handing it to that bank or that servicer, but then that servicer is turning around and giving it back to the governments in the form of these payments through mortgages so that they can then pay off, their debts essentially. And so it's just a really unique time. And I think a lot of that happened because interest rates were driven down because of COVID to stimulate the economy. And then there was stimulus out there. So people had money and were able to qualify for these mortgages. And now we're kind of dealing with the repercussions of that, right? Of how does that look over the next 2, 3, 4, 5, 10 years? And how do we kind of right the ship, if you will? And so there's a lot of thought around that, and in the same way as that, tougher times are coming and servicers are looking at, and I don't want to say it's like only the US government pushing this pressure to keep people in their homes. Servicers know too that if we just foreclose on everyone who's, hasn't paid their mortgage on the 91st day, it would collapse the market because home prices would drive way down, and then it would be a lose-lose situation for everyone, right? So the conversation is happening here is how do we address this in and like on a macroeconomic scale, right? Okay, we look at, let's say we've got 100 defaulted mortgages. Okay, well, maybe 10% of those, the main or one of the income earners in the family lost their job for the last 2 months, so they stopped paying their mortgage. But now that borrower has a job again, and so they can most likely, if they get caught up, start paying their mortgage again. So, when I talk about a loan modification, sometimes that looks like you don't even change the mortgage, just that, 2 months that they hadn't paid, you just put that into a lump sum at the back of, the 30-year, or you put it on over the next, 3 years on a payment plan that maybe their monthly payment goes up $5 or something like that. There's a bunch of different ways on the operation side to look at it of like, okay, this is actually a good borrower, right? We don't want to foreclose on this home. We want it to keep paying. And then maybe, all right, there's 40% that, they qualified for a mortgage that they shouldn't have qualified for, but their home has increased in value. So maybe that's like a full new modification, right? That we put that into a 40-year mortgage, or maybe the lender, servicer, bank forgives a little bit of that mortgage to be able to get it performing. And then you're looking at the other percentage where, okay, hey, maybe there's 15% of these people who need to be foreclosed on. They are not going to be able to pay this mortgage. They are not going to be able, they don't have equity in their home. And we're going to need to sell this asset and liquidate it to be able to recoup our investment, et cetera. But that's part of the mortgage industry, right? I think the average foreclosure rate is somewhere between 9 and 13% on a historical basis. So it's like you're always going to have that, and that's what creates affordable housing. And so that was another issue, right? You weren't allowed to foreclose on people for 2 years during the pandemic. So those REO units that you could buy for cheap and more of the affordable housing went away, and people stayed in their house, and so it really put constraints on the supply, and demand went through the roof. And so again, just kind of in this unique position. But I think giving you guys all that information, and I know Stephanie and I talk about this all the time, there's a huge opportunity on the short sale side, or even really just working with servicers as these people, like you said, okay, maybe I haven't paid my mortgage in 60 days and I know it's getting close to the foreclosure process, but they might not even know that, hey, they've got, $30,000 of equity in this house where they could sell it and pay back their mortgage and walk away with $20,000 or $10,000, or just even and be free of that burden of, the mortgage and what they need to do, and go and find something else that suits them. And, with everything, and that's not going to slow down, right? In the aspect of there's going to be people who are in that box, and that's going to continue to grow. And I think that demand is only going to continue to be a larger opportunity as we continue to see regulation and advisement from the big government boards of that they don't want people getting foreclosed on. It continues to open up that trough, if you will, of borrowers who maybe aren't educated enough to know that they have equity in their house, but they're not paying their mortgage, and want to get out from under it, right? And get into a rental, or, maybe they don't have equity, but the servicer is going to be open to a short sale, et cetera. So that kind of opportunity is definitely just continuing to grow, and I think will continue to grow. But a lot of people, you're not going to hear that broadcast from the servicers or from anyone, because it's not a good sign, right? They don't want people to know that there's people not paying their mortgage who could be foreclosed on, et cetera. And so it's really identifying those opportunities and what that presents to you all as agents and brokers, et cetera. So
John, do you feel, and because I'm sitting here listening and I'm just trying to understand and wonder, and of course you aren't going to have all the answers, but maybe because you're at this conference and because you are at one of the largest loan servicers in the United States, is the government being more responsible, 93% responsible for for the 12.8 trillion in mortgage debt out there. Is that because so many lenders pulled out of financing, like Wells Fargo in 2023 said, we're never going to do residential loans again?
So it's partially, but it's really it came from the previous financial crisis. It came out of the '08, 9, 10, 11, where to give confidence back in like the secondary market and this debt market, people, so let's say like Carrington or Quicken Loans is originating a loan and then essentially selling it off to an investor or whoever's buying that on the back end, if you will, where they own that debt. Carrington's still servicing it, but then we're paying that investor and they're making the percent of interest. There was no confidence in that market coming out of '08 and '09 because of what had just happened, and it had just collapsed and trillions of dollars disappeared overnight. So the U.S. government got more involved to say, hey, we'll broaden our guidelines of what we'll accept as a U.S. backed mortgage to be able to get the confidence and stimulate the economy and get mortgage lending going again. And then it just kind of snowballed from there of then everyone wanted that type of mortgage and they were able to do that. And so it grew and grew and grew. And then, yeah, and I think to your point, Stephanie, as these larger banks are getting out of the lending space, who were issuing off their own balance sheet and doing all this stuff, the independent mortgage bankers, which is a whole subset or non-bank lenders, if you will, were only doing those US backed mortgages because that's how their operation model worked, right? They had a warehouse line or whatever, but it was all contingent on, hey, I'm a Ginnie Mae lender, I'm an FHA lender, I'm this type of lender. And that just grew and grew and grew. And now when you don't have these huge banks in that space, it just continues to concentrate that market. And that's how we got to 93%. And that number's growing,
And it's growing. Yeah, it's going to soon become 100%. So, being at the mortgage brokers or mortgage bankers association meeting for the last couple of days, what is everybody talking, or saying in regards to the interest rates?
Yeah, so I mean, it's funny if we were at this conference last year, this exact same conference, same weekend, same everything, and the thought was, oh, well, the first quarter of 2024, we'll see, rates go up and whatever. And then by Q2, we'll start to see them drop. And everyone was predicting will be, mid fours to low fives by end of the year. That is obviously completely out the window now. And everyone thinks that we'll be lucky if we see one rate cut by the end of the year. But really, a lot of people here I think they're going to hold strong and just they're not going to increase, but they're not going to do any rate cuts until 2025. And that's kind of the outlook. And then the outlook is even if they do cut rates, it won't be enough to stimulate the refinance volume and new purchase origination volume. They think the outlook here is it's going to have to get to low, like at least 5.5, somewhere between, let's call it 5.5 to 6 to start to see real movement where people who have maybe been in their house for 5 years now or 6 years, like, oh, I can handle a 5.5% rate, even though I'm at a 4 or 3.5. And then same on the refinance side. And that's where we're going to have to get to be able to start to see this movement like we were used to, right? And so I think we've got probably another year. The outlook is around this time next year, they think we'll be at that point. So that's definitely, I'd say, the kind of consensus out there.
Wow. You all make sure I know we're giving a lot of information here, and John, this is phenomenal. Make sure you put your questions in the chat because, this is important detail, that we need to know and understand. I want to interject a little bit and tell a very real story of something that happened last week. $2.5 million house, borrower, 820 credit score, putting down 60%. He's financing 40%. Large lender, when I say large lender, I'm just going to call it out. It's Chase Bank. And they did 3 appraisals. First appraisal got rejected because the bank said they didn't like the comps. They want to see other comps. the appraiser kept saying there is no other comps. These are the comps. These are the 6 comps. I can't make up comps. How do you want me? Well, we want you to call every real estate agent out there and make sure there's not some off market comp you've missed. Okay. She can't please them, make them happy. They reject her appraisal. They hire a second appraisal. Same exact thing occurs. The second appraisal is a lot more vocal and telling me these banks are crazy. They're crazy these days. This guy is putting 60% down, you all. He's only financing 40%. Like, that is a dream borrower, okay? So they reject the second appraisal. Actually, she ends up quitting. Like, she went back and forth 6 times and said, I can't please you, I'm out, and whatever. So not a finished appraisal. Third appraiser comes on Thursday. And I tell him, I'm like, look, you're the third appraisal. Here's what's been going on. He goes, I'm already aware of it. The AMA company, the appraisal management company has already told me that this lender is just being absolutely ridiculous. There's been no issues of value, no issues of, there's just not a lot of comps. This house is a new construction and everything that has sold around it is a resale. And you just can't make up enough comps. So anyway, the third appraisal gets rejected at 4:30 p.m. on Friday. The buyer decided at 5:15 p.m. on Friday, he's going to sell his stocks and get the rest of the 40%, and he's paying cash tomorrow at closing. But that is how bizarre lending has gotten. I don't do a lot of residential real estate, as a lot of you know, and thank you, Lord Jesus, I do not. Because if every one of my transactions ended up being as much of a roller coaster ride as that, I don't know how else I don't even know how I could do that, But it's crazy. These banks, now from what I've been told, and John, maybe you have some insight, from what I've been told is these large lenders want to stay the heck away from jumbo. But how is that possible when prices of homes keep going up? Like, what is considered a jumbo anymore? For those of you who don't know, I live in Louisville, Kentucky. We're, a very super, super crazy expensive house here is $2.5 million, but $2.5 million where John is from, or where you even live, John, is nothing anymore, correct?
Yep.
So
Yeah.
how do you make these banks happy?
Yeah. Well, and so I'm so glad you said that because it's very timely as well. We deal with a lot of the banks because we buy a lot of their whole loans and stuff. Like exactly you're talking about Bank of America, Wells Fargo, JP Morgan Chase, et cetera. And they say they're lending, right? Like, oh, we're not, unless you're Wells Fargo, they've said they're getting out of the lending space. But that's a perfect example. They say they're lending. We see on the commercial side too. Oh, yeah, we're lending, doors are open, da da da. But if you talk to them, actually, like we've had a lot of these conversations, it's exactly like what you just said. They're going to look at a loan app and they're going to take that in, but they are not actually lending and they are not actually moving on paper because they don't want to. And a lot of the reasons the big banks aren't is because the local, let's call them regional banks and community banks who have been under some stress, who generally do a lot of loans, a lot of these big banks are having to buy up their paper, right, as they get bailed out by the FDIC and that whole situation. And then they don't really want to be in the business, right? Because if Wells Fargo forecloses on, one of their homes and it's an issue, it's going to be front page of every major newspaper out there, right? And it's like, okay, so why would I take this huge risk that's not making me that much money? And if I make one mistake out of the trillion mortgages I have out there, it could drive the stock price down 15% and, CEOs getting fired, right? Where it's like there's essentially easier
My
ways.
AirPod was connected. How do I get the audio?
Okay, sorry, John.
No problem. And so that's what you're seeing, right? They're saying, oh, we're lending and we're doing this, but they're not really. And so everyone on the phone, you should have 3 or 4 lenders that you're checking in with weekly to make sure they're actually lending and what, they're lending on, right? So and then the jumbo thing is another hilarious topic because I had a call with, I won't say what bank yesterday, and they're like, we're not touching anything on the jumbo side. So they want to try and sell it off. They're going to sell it at a discount to get it off their books. And jumbo's anything over, I think they just raised the limit of what a jumbo would be. It's anything over, I think, 550,000 on a mortgage side. So it's
What do
like,
you get for 550 in this day and age?
yeah, exactly. So yeah, it's just very timely conversation. Yeah, you're seeing it out there.
It's crazy because it's like I feel for the loan officers because, if you ask a loan, oh yeah, we're doing this left and right, but is their bank telling them they're not really going to get paid this month? Because I would assume okay, there we go. I would assume, because this loan officer at Chase, I mean, he's like, no, we're going to get this done. No, you're not. I mean,
Yeah.
obviously, all signs are pointing to no. We're just going to go with no. And, unfortunately, the buyer has a massive tax implication now that he's going to deal with because in order to buy that house, he had to cash out stock, which means he has to pay taxes on all that now. It's huge. Gosh, it's crazy. It's crazy. I see in the comment in the chat that others have been through this. And yes, Jennifer put, Stephanie, I typically see appraisals waived. That's what I thought. I'm like, why isn't this appraisal waived? I mean, I can't even believe that we're even dealing with this. I would love to lend somebody 40%. I mean, you have such an upside there. Worst case, he doesn't pay, you kick him out, you sell the house, you still make money. It's crazy. John, what else are you? I mean, when you look at your company, Carrington, are you seeing foreclosure rates rise at all? Or are they
So
still
it's interesting. Like, like I said, I think the bucket that we could move to foreclose on is growing, but we're getting a lot of guidance of, hey, here's this new loan modification program. Here's this new mortgage product that, and because we are a large government shop, before you foreclose, and when I say we get guidance, you have to offer all these loan modifications, these different products to the borrower before you can go through the foreclosure process. So there's a combination, right? Like I was saying earlier, of, we don't want to foreclose on everything out there, nor does every servicer, right? You want to give the borrower a chance to get back, but also you have to go through these steps till you get. So the process, let's say, obviously it's different state by state, but let's say the process used to be around 100 days, right? If someone, their 91st day, you give them notice, hey, you're officially in foreclosure, we're starting the process, and maybe it'd take 100 days to get them out of the house, then list it and go through that process. Now it's like a year. So that pipeline is just, so it looks like foreclosures are at an all-time low because partially due on purpose. They don't want, with an election year, they don't want high foreclosure numbers. And there's a lot of new programs and stuff coming out like that to kind of slow that process down. And so, but it's just also taking a lot longer to get through that process. So those, like, if you look, like, foreclosure numbers are at historic lows because it takes so long to get through the foreclosure process, and there's so many options to get a borrower, back into a loan modification. But there's some crazy statistic that, like, once a borrower has done one loan modification, and if they go to do a second, basically, there's like a 95% chance within 12 to 18 months they get foreclosed on. It's like if you get through one modification, you get current, you keep paying, then you'll generally be a good buyer. But if you have to go for another one, then it's generally like a 99% chance you're gonna, but then they get 3 or 4 more chances, right? And you do another loan modification and try to keep them going, and then, but it always ends at the same kind of result. So
Are these loan modifications, are they staying at the same, let's say they have a 3.3 interest rate when they got the loan and then they've lost their job, they can't pay their mortgage. You all reach out, we want to do a modification for you. You're keeping the rate the same? Nothing like that, that's not changing, or you are changing?
no, the rate is changing. The rate is changing, but
So that's probably why they're set up to almost fail, because if they couldn't pay the lower payment at the lower interest rate, how the heck are they going to pay the higher payment at the higher
right.
interest?
Well, and that's why they came up with the 40-year mortgage, right? To try and lower that. Yeah, offset that. Or, there's different programs like we talk about, like, okay, the first, it's like a variation of like an arm, if you will, where, hey, it's going to be structured as a 30-year mortgage, but the first 5 years or 2 years, you're going to only pay interest only to keep your payment down and hopefully get a job and get back performing, but then, it's all going to come due eventually at some point, right? So there's a ton of those different products out there that you kind of have to go through.
Well, that's important though for everybody that's on the call today and everybody that's going to watch this video when we post it to Grow Global. What's important here is that, look, there is a lot of people with equity. They may not be paying their mortgage because they can't afford it. Circumstances have changed, but they do in fact have equity in that property. It's not necessarily going to need to be a short sale, because here's the thing, like John's saying, they have the right to go through this modification, and the banks are being told, please do modifications with your existing customers that with these mortgagees. So the thing here is that they know the payment's going to adjust. They may still not be able to keep up with that. And so the marketing effort is, instead of advertising for short sales, because they may not be a short sale, short sale your home, maybe that, that's not what it is, but are you having trouble paying your mortgage? Reach out to me and let's find out how much equity you have in that. Because yes, you can apply for a modification, but your terms of your loan and interest rate are probably going to adjust, right?
Yep. Yeah, and I think too, it's just educating people like we've seen is educate, because if you're, a regular, let's call it borrower, you're not in the real estate industry. And I think we take a lot of this for granted of just having that knowledge. But all you see on, the news is home values plummeting, everyone's underwater, yada, yada, yada. So it's maybe educating in your local market of, hey, actually, this is what home values are in this area. And, typical mortgage is X, right? And so giving that information to them and advertising like, hey, I know you might not be paying your mortgage or can't, but you might have an easy out where you can make $5,000, $10,000 or whatever. And they don't even know that because they just see everywhere saying that, home values are down so much. Like a prime example is I live in Austin, and, a lot of these statistics they put out are from the peak of the market, right? Like, oh, Austin home values down 40%. It's like, yeah, well, if you didn't buy your house during those 3 months, you're still up 20%, right? But if you just read those facts that they're putting out, then you're like, oh God, is my house underwater? Like, do I even know that? Oh, I don't want to spend the money to get an appraisal. I'm not going to talk to anyone. Like, I'm not paying my mortgage. Like, you feel trapped, but then just educating them of like, okay, if you bought during this time, here's where home values are. You might still, be ahead 10% or whatever. And hey, people are buying in this area still, kind of thing. So I think it's just that information and education is so big.
I love what John just said there, because it's true. I saw that headline. I know a ton of people in Austin. And when I saw that headline, like what the public would say, I'm like, geez, Austin's fallen out. I mean, Austin, everybody needs to be rescued in Austin, Texas. But, you take that in this real estate profession and you take those headlines and you twist them and tell the public exactly what is happening, right? Versus, because look, the media is out to get as many watchers and readers as possible. So the worse they make it sound, the more people will get engaged with it and read it. So, there's your marketing opportunity this year, folks, is to go through that. Laura had a question in the chat, John. She said, when they do the loan modification, are those government-backed loans? If they weren't, do they become government-backed, or were they already?
So if they were originated, so there's a few different programs, right? So if it was when it was first originated and it was not government backed, then the loan modification won't be government backed. If it was in the beginning, there's a bunch of loan modification programs in, let's say it's a FHA loan, in those guidelines that can keep it that way. But there is also options to basically remove it from a government backed loan into a conventional loan, is what we call it, as well. So it really just depends on the borrower and the situation and what's available.
Sounds good. John, I'm not sure if we're going to have expertise on this, but let me see. Jennifer Mendoza has a situation right now on a reverse mortgage. Do you all service reverse mortgages?
We do. We didn't, but last year we've started to get into that space.
All right. So she's got a client's mother who had a reverse mortgage and she passed away in August of 2023. No one paid the mortgage, so they're now in foreclosure. client needs to go through probate, but there's any advice on how to get anything postponed because it's already scheduled for foreclosure auction on July 2nd. Maybe I'm confused, but I thought on a reverse mortgage, there isn't anything being paid. You're not paying a mortgage because they're paying.
Right. You're being paid.
Yeah.
Yeah. So that's interesting. I think and again, it depends. There's a lot of different reverse mortgage programs out there. So it could have been that this mortgage was whenever the borrower passed, that then the bank took over the sale of the asset and then is selling it to basically recoup its value that it's paid out to that borrower over the last 5, 10, 15 years or however long that was. But it's really going to be kind of dependent on what reverse mortgage that borrower was in. But that's kind of the thing with reverse mortgages, right? Is the bank owns the asset and they're paying you for it instead of you paying them. And so then when it ends or someone passes away, the bank then owns it and sells it to then recoup their investment back.
Yeah. And in the past, when I was doing a lot of short sales and I would see reverse mortgage holders filing foreclosure, a lot of times they were doing that because other liens were put against the property and they were just doing the foreclosure sale to get the other liens removed off of the title. So Jennifer, that might be that, but I would definitely reach out to an attorney in your market to get, clarity on all of that because there's too many hypotheticals in that scenario.
Yeah, and definitely want to potentially also reach out to the servicer and just try to get an understanding of what type of mortgage was in place in the first place.
Absolutely. No liens on title as of yet. All right, Jennifer, good luck with that. Let us know. We'll get an update from you in a couple weeks when you figure that out. So John, so we don't think rates are going to go down. Obviously, nobody has the 8 ball to look in and tell us that. Home prices haven't been plummeting as much because there's no REOs coming to market to lower the comps, the comparables. That makes complete sense, right? Modifications are being done. And so, we had this call maybe 8, 9 months ago, and we were talking about, hey, start marketing for short sales because we think that's probably going to come about. Well, now there's still an opportunity as it relates to people needing these modifications and, cashing out equity and seeing what more you can do to bring more inventory into the market. John, speaking with everyone that you're with there in New York, any other things of insight that we're missing today?
Yeah, I think just speaking back towards like what we're talking about with people having equity and those opportunities is a big topic of conversation is, second mortgage product, right? Is these people who, on the flip side, maybe, are still paying their mortgage, obviously, but they have this untapped equity, right, in their home. I think I saw some statistic that there's like 28 billion of untapped equity in the market right now. And it's just huge numbers. But again, people don't really understand that. And I think the biggest thing of the opportunity is really, again, just educating people in your local market of options if they are interested in selling. And really, I think showing that of, hey, this is potential equity in this market. Here's, what you could potentially sell your house for. Here's, different options. And then just staying up in front, knowing the market's slow, but knowing that it's going to eventually break here in the next, let's call it 9 to 12 months, which could seem like a long time, but I think it's going to go a lot quicker than it seems as we're already in May of 2024. And then people are just going to have to move. And there's still a lot of people out there with a lot of money and, who as much negative and stuff you hear about the housing market and the economy and stuff, there's still people who want to move for some other circumstance. Maybe they got a new job and they need to sell their house and it doesn't really matter what the interest rate is. So there's still going to be that kind of driving force of people moving. And then I think, as an opportunity as agents and you become that local expert and, understanding what other products are out there and how you can continue to make money. I know there's a ton of these second mortgage providers that work with real estate agents and pay a referral fee if their client, comes in from them and, does a second mortgage or one of these products. And I think just understanding what's out there and how to be, kind of a Swiss Army knife instead of just oh, hey, I just sell homes or I do this. It's like understanding every little part about your market, the short sale market, the second mortgage market, learning about all of that. It just makes you so much more well-rounded and really shows your value in this kind of tougher market, if you will.
Awesome. So Laura put in the chat, how will lenders, banks, servicers handle the foreclosures, the one that they do have to foreclose on because, the borrower is not taking advantage of all the modification? Are they going to be reasonable on waiving fees and other costs so that it can close a lot easier? Or is it still going to be the headache and the churn and burn and the heartache and heartburn that it was back in the day?
Yeah, I wish I could say it's going to be smooth and easy, but it's just the reality is it's never as easy. There is a lot of talk about, slashing fees and helping with different stuff to make the sale easier, but it's not an easy process. And I think that's what makes the people who are unique, who are good at it, very unique and very, like we talked about on the last call, is servicers and lenders and people want to work with good agents and brokers. And that's what I was saying. Continue to arm yourselves with those tools and information and understanding the market, because that process is just a nightmare. I mean, there's no sugarcoating it, right? It's tough on the borrower, it's tough on the servicer, but then, they will comp fees and whatever, depending on every single situation, right? If they need to move a house and understand, and it also depends on which company you're working with. Some servicers are harder to deal with others because they want, they just want to get every penny they can and they don't care if it takes longer to close, versus some are just all about speed and moving through the process and getting it off their books, etc. So I think it's a long-winded way of saying there's no super easy way to get it done, but yeah.
Nothing's ever going to be easy when it amounts to money, right? I mean, come on,
Exactly.
that's why we earn our good money, because it's worth it. We have to work for every penny of it. That's for sure. So
Exactly.
well, no, this has been amazing and eye-opening. I still can't get over the fact that $12.8 trillion worth of mortgages are outstanding in the United States as of today, and 93% are insured by the government. Gosh, isn't that a question on what we need to be asking our two presidential candidates? Like, do they even know that statistic? That's what I want to know. Do they even know that statistic? Like, where are they going to be on a rally next? Wherever they're going to be next, go and ask that question. I think both of them fairly will be like, what? I
Oh
seriously
yeah.
doubt that they have even thought about that. But that's scary because that is, I mean, look, everywhere we look, we all want to have people get helped, but I mean, at the same time, the government can't keep paying for everything. It's going to run out.
Yep.
Gosh.
So yeah, we'll see. We'll see what comes of it. That's for sure.
Well, this has been amazing, John. We absolutely love when you come. For those of you who don't know and haven't seen John before, we do have two other videos on our Grow Global website, and they are phenomenal for you to watch, get business ideas, way to market, how to use this information to your advantage. Because look, we're not paid to sell houses. We're paid to be the experts. We're here to earn people's business by providing value. And so this is what we need to do and know every single day of the week. One more comment just went in. Let's see here. Let me look real quick. Oh, good. We've got our website links here in the chat. John, I want you to type your information in the chat. John is part of Villa Title, which is also owned by Carrington, and they do closings in all 50 states of the United States, and they do every single closing that I come across. So thank you so much, John, for coming. Put your information.
Thank you. Yes, will. I will do.
We'll make sure to put it in the comments as well. Thanks, everyone.